Warm greeting to our Pair Trade Finder Pro members. We're going to take you through the trade of the month for January 2021, and it's the first trade that we review out of our new Fast 50 U.S. equities pairs, which you may remember are done on a much shorter time frame, 21-day lookbacks, and using a 42-day moving average. So more aggressive and more signals, and we're going to go through one of the ones that happened in January, a trade that closed in January, and take you through why we would have chosen it and what the results were. So the two companies involved are Autohome Inc. and it's paired with Twitter Inc. So both of these are in the content and information services in the internet subsector or industry subsector. And we've chosen them even though prima facie on the descriptions they're not exactly the same. But if you see the statistical and quantitative analysis of this pair, you'll see why we really like it. So first off, Autohome, it operates as an online destination for automobile consumers in China. It's based out of Beijing. They run the autohome.com website and che168.com websites. Basically, they are a portal for everything automotive in China, and where all of the users can send messages back and forth about everything automotive, and the automotive industry can promote their services, cars, insurance, everything like that through short messages and through online messages through the website to a very wide customer base across the whole country. And that's paired with Twitter. Most of you probably know Twitter as a platform for public self-expression and conversation in real time, United States and internationally. But the important thing to remember about Twitter is that the company offers various products and services, allowing users to consume, create, distribute, and discover content, and Periscope, a mobile application that enables users to broadcast and watch live video with others. It also, and this is the most important, promotes products and services such as promoted tweets, promoted accounts, promoted trends, and which allows advertisers to promote their brands, products, and services. So at the end of the day, they've created this huge online marketplace, Twitter, where though it is public discourse, a lot of different companies are using it as a promotion platform for their products and services. So there you have it. Those are the descriptions of the two companies' activities. Looking at them on a financial fundamentals basis, as we mentioned, it's in the internet content and information industry subsector of the communication services sector. And price of 138 versus 75, so those two prices are in a good ratio. The average volume, they have lots of volume. The betas are very close, about 0.7 versus 0.8, 0.9. Market cap of At Home is about 16 billion. That's actually the enterprise value if you dig deeper into their statements, versus about 54 for Twitter. That's within tolerances, about 3 to 1. And we look at the valuation ratios here are kind of screwed up. You can look at price to sales, that's not too far off, 12 to 15. But the rest you have to delve into financials, and you can see there are some quirks why these aren't coming out as obvious similarities here in the valuation metrics. But if we go with the top line ones, 12 versus 15 on sales. There's a small dividend paid by At Home, whereas Twitter doesn't, but it's so small as to be almost de minimis. And Zacks rank on At Home is 3 versus 4 on Twitter. Those are pretty close. Leave it up to you to decide whether that's close enough, or if we're going to go short Twitter and long Autohome, where it might actually be in our favor. The next earnings dates, well, let's get into a few more things here first. So I'm going to exit this. Let's go why we chose them in the first place. And if we look at the back test for this pair, this is why we really like this pair. So over the last 2 years, there were 17 trades. Okay, that's a lot of trades. The average correlation was over 50%. Co-integration showing at 0.86. When we chose this pair, it was 0.88. Compound annual growth rate of this pair was over 47% unlevered, and a max drawdown of 20. So two and a bit to 1 reward to risk. Gross profit of 3,673, net profit of 3,471, average net profit of trade of 200, and 88% were winners. Could I just make something very clear here? Because we're looking at a Fast 50 US equity pair, we usually, in our previous top 30, would be trading at 10,000 a leg. As we mentioned, because these are highly aggressive pairs on very short-term look-backs, and using a longer ratio moving average than the actual standard deviation and stretch lookbacks, we have downsized the position sizing on all of these quite aggressively. So we when you auto load these, we trade them at $3,000 a leg. So if you're on a average net profit a trade of $200 on $3,000 a leg, you're looking pretty good, because the margin required to hold a trade on per trade on 3,000 leg is about 1,250. So this is returning about 16-17% on margin for every trade on average. And one of the great things depending on your point of view, about this setup of these FAF 50 is the average days in trade is about 11 days. So as we said, much faster trades. Now, if we look at the equity line, while this ratio was trending at the beginning of the 2-year look back period here, you see it didn't make much money, but then it flattened out, and we got a lot of volatility and lots of zero crossings around that ratio line. And as you can see, that led to a large number of nicely profitable trades. And this equity curve, bottom left to top right, almost all of them winners, if not all of them winners in this time frame. So great looking pair. We loved it, and that's why we chose it. Another thing we like to check, if we go to Auto Home, you can see that it's gently rising, uptrend. Then this is the recent history, starting to spike. But when this trade was called, it was called on December 28th, I think, so right around here. Gently sloping uptrend. What was Twitter doing? Same thing, gently sloping uptrend. And the relative price performance over the last year, you can see diverged, reconverged, diverged, reconverged, diverge, reconverge, diverge, reconverge, diverge, reconverge. And this was our trade that we took, I think, right around here. So you can see the co-integration and correlation that's in effect here. Very good looking pair to trade, and you can see it's diverging again here. It might give us another trade. So that is why we chose the trade. Now, what's the signal that we actually traded? So this one was on December 28th. The signal was to go long at home, short Twitter. Now, if you remember those Zacks ranks, you would be comfortable with that, because the Zacks rank of at home is higher than the Twitter Zack rank. And it was at negative 2.57 standard deviations. You can see it here, and you can see it on the plus minus chart here. And when that happens, what's the first thing you need to do with any trading signal? Well, the first thing you need to do is check news. So we go to Auto Home Inc.'s investor relations page, and we can see that on 12/25 they did announce something. They just announced that they're going to hold an extraordinary general meeting on February 2nd. That's also when they are announcing their next set of results. Previous to that, the last results had been announced at the end of November. So we got lots of time from the date of the signal, 28th of December, until the next results, which are February 2nd. So it gives you at least 35-40 days, and the average time in trade for these trades is about 10-11 days, so you have more than enough time. Then you go to Twitter, see if anything else was posted around that time. Their last post in 2020 was just a PR post that they're presenting at Barclays Global Media Conference, and that was released on December 2nd. If you look at 2021, you can see that they also announced that they're going to do their fourth quarter and fiscal year 2020 results on the 9th of February. So we have lots of time between the signal, which is the 28th of December, and the results of both companies, because they're going to be the first week of February. So we have about 4 or 5 weeks of time, and the average trade on these is about 10 days, so about 2 weeks. So more than enough time. The next thing you would then look is very quickly to see, so we checked earnings dates, dividend dates. Well, we saw previously that the dividend on at home is pretty de minimis. It's 0.6% a year, so even on a quarterly dividend, you're looking at about 0.15%, and we're going for much more than that. We are also long at home, so we'll collect that dividend, and we're short Twitter. So we won't have to pay any dividend on Twitter, and we collect any dividend on at home. So from that point of view, we don't have to worry about the dividend. If anything, if it does get paid, it's in our favor. Check the date on when it gets paid. Now, let's go back to pair chart analysis. So would you have taken this trade? This is a 365-day look back set of charts, and here's where the trade was called. what can we see here? Well, we see, gently sloping downwards, but basically flat ratio line over the last year. And if we look at the plus minus chart, we can see that this one happened at negative 2.57. It's right in the range of where all these trades have happened. And if you look at this pair, it's just been so consistent. Entry, exit, profit, 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 profit. And here's the latest one that gets called. So on the basis of this support level, let's call it on the entry stretch line, that looks good. If we look at the percent from mean, again, all of these tend to get called at about negative 10 to negative 14, and this one was at negative 12.44. So again, sitting on that sort of support line here for a maximum percent from mean, that also looks good. So when you look at both the plus minus chart and the percent from mean, they both look good. What else do we want to look for? Well, you've got this downtrend in the ratio, and you want to look at your RSI chart and see whether you got any divergence here. Well, a couple things to notice. First, it's at a major extreme. It's only at about 18, something like 18.88. So very extreme reading, but also, depending on how you want to read divergence, but if you look at this period here, it's about, I guess, about 3 weeks, it's flat. And even here, it's sloping upwards. But let's just call this flat. And here, you're going downwards. You've got between the low and the low here, that's a downward slope. And then here you've got flat, and here you've got going down. So is it strong divergence? Depends how you read it. It looks like there's a little bit of divergence there. So that could have also bolstered the case for entering. So on that basis, you've checked the news, it's fine. You've checked dividend and earnings dates, they're fine. You've run your pair chart analysis. That looks good. You could also look at correlation. You want to make sure it's still in place, but in the interest of brevity, we'll not go through all the different charts. But there's one final thing you need to check before you place the trade, and that's volatility. This one is currently reading 4%, which on a normal set of lookbacks would be quite high. But because we're using shorter lookbacks on the standard deviation and stretch than we are on the moving average, that's actually not a crazy level of volatility. You see some of these are up at 6, even higher. But nevertheless, it's volatile, so you'd have to decide your position sizing accordingly. However, as we mentioned, because we know these are all volatile and they're highly aggressive, we've marked back our position sizing on all of them to $3,000 a leg. And so had you taken this trade at $3,000 a leg, what would the result have been? Well, if we go back to our trade history, you exited on the 8th of Jan, and you made about $5 a share on your at-home long, and you made on both legs, so you also made about $3 a share on your Twitter short. So a very good trade. It, as we said, it entered at negative 2.57 stretch. It exited 0.27. So you got a big kick up on that day, end of day exit. And so you blew past the negative 0.8, which is our traditional exit on this set, and you went all the way back to and across the moving average line. So it gave you a very nice profitability here, $456 of profit. And remember, we're talking 3,000 a leg, not 10,000 a leg. Were that to be 10,000 a leg, that would be something around $1,500 of profit, if not more, $1,600 of profit. So again, the margin required to hold this trade at 3,000 a leg, if you're trading 5-to-1 margin IBCFDs, you would be looking at about $1,250 of margin, and your return was 456. That's almost 40% in just over 8 market days. So 40% on margin in 8 market days. It's a great trade, and it's one that you probably haven't seen before because it's a new addition to our Fast 50. So I hope you like that. I hope it was useful for you to learn how we look at trade entries, all the steps you need to take, and also to see a great result from one of our Fast 50 U.S. equities pairs. Thank you for listening, and we'll see you on the next trade of the month in February.